this is Mike Masha at Cadwalader. Thanks for dialing in to Fund Finance Friday Industry Conversations. We enjoyed adding video last week. Appreciate those of you who were able to make time to watch. I watched the final cut with my 8-year-old daughter, Christina. And as you can tell from this photograph, she had plenty of really positive feedback for me. We did learn a lot watching the videos. We'll try to improve them each week. We'll also try to keep the overall clips a little bit shorter so they're more manageable. At Cadwalader, very little update or change in the last week in our funds finance practice. Transaction volume stayed very steady. Still not consulted on any sort of credit distress in any transaction in our portfolio. This week, we've got a good handful of great visitors, starting with Charlie Owens, Managing Director at Signature Bank. Charlie, thanks for joining us.
Happy to be here, Mike. Thanks for asking.
You bet. So, Charlie, it's been about a year since your transition over to Signature. How's it going?
Yeah, it's hard to believe, Mike. It's already been a little over 18 months now, but can certainly give a perspective, both micro and macro. So starting with the micro, it's still being based here in Charlotte and setting up what I'll call a proper office from the beginning. I often joke that I'm on day 560 of lockdown, so I pretty much have everything to nail down to a science. But it certainly was at least an initial transition away from, I'll call it a traditional office space, or frankly a trading floor environment, to working from home and having to create some background or white noise just to deal with what I would call a lot of silence. And then from a macro standpoint, it's certainly been a lot of fun just building another business from the ground up, whether that is developing the business strategy or hiring new team members or developing the policies and procedures that we would use obviously every day. And then of course just dealing with and working with senior management of the bank, who's been very, very supportive of our practice and our growth over the last call it 18, almost 2 years now for the entire team.
Well, speaking of hiring, you guys have hired a number of the really most senior experienced bankers in all of fund finance, as well as a lot of go-getter types. How's that integration going? How are you guys structured, and how are you ensuring cooperation and not competition amongst your team members?
Well, you're right, Mike. We certainly hired 6 MDs from some of the top institutions across the industry. And maybe to be a little corny for a moment and to coin a phrase from one of the team captains from the University of Virginia baseball team back in the late 90s, we're trying to view it as a one team, one dream type approach. And from what our group head, Tom Byrne, had as his vision whenever he was talking with senior management and forming the team in the group, he wanted it to be one where you had a very much of a team approach to growing the business versus having individuals run different coverage and oftentimes probably overlapping each other. So you asked more specifically, like, how are we structured and how is the integration gone? Each of the 6 MDs on the origination side, we're not bound by geography or sector or market type coverage, but rather who has the long-standing relationship with a given client name, or even better said too, with a prospect who has a better call into them. And oftentimes when you have 6 MDs, you will have overlap, but then it's also just determined from that overlap who has that better calling effort, or sometimes it's determined that it needs to be a co-calling effort. And we've done that a couple times now, even of late, and it's worked out great.
You guys have certainly seemed really busy and open for new business since the COVID disruption started. How are you all looking at the market now?
You're certainly right. It has certainly been an uptick in demand of late, certainly the past 8 or so weeks. And not only do we have a regular pipeline that we were contending with, but also just the influx of the inbound calls, because some of the other market players were kind of in a pullback mode. But I would say our approach has still been highly consistent. Again, the first of which for the approaches is that we have MDs that have very long-standing industry contacts and relationships, and we continue to basically take advantage of those. And secondarily, we've worked very hard over the past, call it 2 years, on building our brand and our brand awareness, and all of those efforts are really starting to kind of come to fruition now. So we'll have a lot of referrals from various sources, whether that's other banks, existing clients, law firms, and even some advisors out there.
Have the number of opportunities gone up materially since the disruption started?
Yes, they've gone up significantly. So I would say at least have doubled in the number. So if we had 10 we were looking at before, it's 20 today.
Yeah. And is there a particular segment of the market that you guys are focused on?
No, we're still kind of agnostic relative to the sector. But like everyone else, our forward pipeline is still highly dependent on like the fundraising activity out there. So of course we continue to monitor that, and there's a couple of different sectors that we see that are going to see either are seeing or going to continue to see kind of an uptick in activity. The first of which is the secondary funds, and then again it's going to be the distressed or what we're calling dislocation type funds. Some have already announced, and of course we're hearing some market chatter that there will certainly be others. So again, agnostic on as opposed to the sector, but we'll definitely focus on where we see the opportunities coming.
And what about product offerings? Are you pure subscription, or will you look at hybrid and NAV facilities?
Well, Mike, given the current environment, we've been very cautious around both the hybrid and the NAV facilities, and instead have focused a lot of our efforts on the significant increase in demand for the subscription part of our practice. So while we do look at both hybrid and NAVs, that has not been the focus of late.
Got it. And when you are looking at those facilities, how are you thinking about structuring them? Is it more a diversification type of structure, or more of a ground up underwrite of the individual investments, or how do you look at NAV facilities?
I would say it's more of the former of that, Mike. We don't do a real huge deep dive on the asset basis, although that's part and parcel to the overall, I'll call it, underwriting and structuring of either a hybrid or a facility. But there's other aspects we'll look at too, just like the underlying sponsor and their track record. Of course, the underlying uncalled capital and the mix of maybe uncalled capital to the fund NAV. And if you get more granular, just at the facility level, like what advance rates are we trying to assign, the tenor, and then of course the covenant package that would come with it.
Yeah. So switching gears, Charlie, your son William won the state championship in North Carolina in high school football last year. What position does he play?
He's left tackle.
And he was a junior last year, right?
That's right. He's a junior. He'll be a senior next.
Great. Any update on whether preseason two-a-days will start in August like they normally do?
Actually, your question's very timely. Just yesterday, the state, via both the governor and then the athletic association, announced that they were going to open up the summer activities, which of course includes football, next Monday, so June 15th. However, it's a two-pronged kind of approval process. It's at the state level, but also at the county level too. So our county where we live came out and said they weren't going to actually open up until July 6th. So a couple weeks back from that.
Gotcha.
And then we get a note from the coach as well, just saying that even come July 6th, the practices will be modified significantly, meaning that they're going to separate a lot of the team. So skill positions versus others.
Gotcha. Well, I certainly hope the season ends up going forward for them, and invite us to a game sometime. We'd love to come watch them play.
No, I certainly will. It's a lot of fun. It's a great team, and they work really hard.
Great. Well, listen, Charlie, thanks a bunch for visiting with us today. It was great to have you.
No, of course, Mike. Again, thank you.
So next with us is Ken Pierce. Ken has been at the intersection of the fund finance and insurance markets for ages, and as of last week is the newly minted CEO of Lockton Capital Markets. Ken, thanks for joining us.
Thank you. Thanks for having me, Mike.
Well, Ken, congrats on the new role. Tell us a little bit about Lockton itself.
Thanks, Mike. Lockton is one of the largest insurance brokers in the world, and it's by far the largest privately owned broker in the world. It was founded about 50 years ago. It has 110 offices around the world, 7,000 professionals, and it originates about $30 billion of premium for the insurance industry. So it's one of the larger insurance broker, advisor, intermediary firms in the world.
Great. And now in your new role as the CEO of Lockton Capital Markets, what's your mandate?
Well, there are numerous intersection points between the world of insurance, the world of capital markets, the world of alternative assets. And this convergence, if you will, of insurance and capital markets has been a major theme for about 25 years. And about 25 years ago, I left my law practice at the law firm that I grew up in and went over to Lehman Brothers to help set up one of the first convergence businesses at a major Wall Street firm. And so over the past 25 years, the convergence of these different worlds has evolved and in different directions. My mandate at Lockton Capital Markets is focused on basically acting as an advisor, a trusted advisor, and an intermediary and a structurer to bring this sort of convergence technology into the platform of a major global insurance broker.
What exactly is like your business model, and who is the principal funding source on your transactions?
Well, if we step back for a second and we focus on the insurance industry and their needs right now, life and annuity insurers in particular write insurance products that are asset intensive in the sense that they write their products. It could be retirement annuities, it could be disability, it could be long-term care. And a lot of these products are very asset intensive, and they're priced with the assumption that the life and annuity company will be able to invest the premiums in largely safe fixed income bond assets and generate sufficient yields over time to satisfy the liabilities and to pay a return to their shareholders and to make a profit. Given what's happened in the world of with lowering interest rates and with spread tightening over a long period of time now, the life and annuity industry has a need for yield. There's a need for yield that used to be satisfied with traditional broadly distributed corporate bonds. And so the need for yield to satisfy liabilities on products that they wrote and products that they're writing today is driving the industry into the world of alternative assets as the place in which yield enhancement can come in a world, as I say, of declining interest rates, perhaps even negative interest rates and spread tightening. And so for them, alternative assets provide yield. For alternative asset managers, we're finding that many assets, many asset classes, many funds are not financeable at the asset level. I know obviously subscription lines and financing against capital commitments is a product that has been around for some time. But what I'm talking about is financing of assets themselves, either at the fund level or we often create SPVs where we isolate those assets. And so we're talking about NAV financing or financing of assets to provide financing and leverage to funds and to their LPs and their investors around assets and asset classes that are not traditionally financeable. And we're talking about packaging and structuring those financing transactions in a way that is particularly appropriate and conducive for financing by insurance companies. And that involves some structuring and other sort of features to make them digestible by the insurance companies.
What other specific product offerings will be relevant for the fund finance market?
Well, there are sort of four general product areas, if you will, the way that we accomplish these financing transactions. The first is relatively straightforward. We will have a portfolio of assets and a manager of those assets who has an expertise in that particular asset class. And we will provide for that fund or account or SPV. We will provide financing in a relatively straightforward way. It could be through a term loan, it could be through a delayed draw term loan, it could be through a revolver line, but generally speaking, a straightforward financing of assets with some investment period, some dry powder to enable the asset manager to use this funding facility to take advantage of opportunities that might be emerging over short periods of time. So that's sort of product offering number one, is just straight up delayed draw term loans and other similar types of traditional financing. A second product that we've had some success with is to use a different part of the insurance industry, namely the property and casualty industry, to provide risk transfer capacity. So to shift the risk that the financing of a portfolio of assets, the risk that the lender might experience a default, either the failure of that aggregate portfolio of assets to generate sufficient cash to satisfy the interest payments on the loan, or ultimately default on the loan principal, to essentially have an insurance policy that that wraps that risk. And with that insurance policy in place, we can go get funding from the bank markets. Many banks, with that risk transfer to a highly rated insurance company, will then finance those assets, or we will create a rated note using one of the rating agencies to basically substitute in the credit quality of the insurance company for the credit quality of the underlying assets. So that is a credit enhanced note offering, if you will, using the insurance industry in a slightly different way. The third area or product that we're very focused on these days is relatively new. And what we're doing is, if we step back for a second, it's interesting. Over the past 10 to 15 years, multiple asset managers, especially fixed income asset managers, have developed their own annuity companies. The most famous one, of course, is Apollo, who was the sponsor of a very large annuity company called Athene. And there are probably 20 of them, major players out there now. So over the years, I've gotten phone calls from asset managers asking whether they could set up the next Athene, the next annuity company that accesses underlying insurance flows to provide funding for alternative assets. And what we've done is we've been working with annuity companies to create reinsurance structures to enable alternative asset managers to access the underlying flows of annuity products to create their own mini Athenes, their own mini annuity companies that access the underlying retail market for funding. So that's relatively new. We've successfully closed 4 of those transactions, and we're kind of excited about that. And then finally, Mike, one final point to make is that we are also developing structured products around the financing of alternative assets, and distributing them in through an alternative channel that that is, again, relatively new, and that's to the family office and the ultra high net worth channel. So we're working on some very large transactions now where we're taking an account managed by a well-known, highly regarded private equity manager, and marrying that managed account with a zero coupon bond and creating a principal protected note, not for distribution into the insurance market, but for distribution into the family office and high net worth market. So there are multiple products and techniques to deliver this type of NAV financing or financing against alternative assets.
Well, that's just great, Tim. Look, I'm super happy for you personally. I think you're entering the market at exactly the right time here. Really wish you the best, and if we can do anything to be helpful, please call on us. Thanks a bunch for joining us today.
Thank you, Mike. Appreciate the time.
So this week we wanted to include a segment with an update on the European fund finance market. To cover that, who better than Cadwalader's own Sam Hutchinson. Sam, thanks for joining us.
Thanks, Mike. Great to be here.
Yeah, how are things going in London?
Yeah, so we are slowly coming out of the lockdown. More and more businesses are starting to open, so things are starting to feel a little bit like we are returning to some sense of normality. I think as a team, we've continued to be really busy throughout this post-COVID period. So yeah, things are looking pretty good here.
Good. Glad to hear it. So what about on the fund formation side, Sam? Are funds still forming over in Europe right now?
So I think, Mike, we're still seeing a bifurcation in the market between sort of the larger, more established managers and the smaller and the first-time funds. I think the larger managers are still raising pretty successfully. A number of large funds have closed here in Europe, including Ardian, the largest secondary fund ever raised recently. We're also seeing a number of distressed and special sit funds being raised pretty quickly. But I do think that the pandemic has really impacted some of the smaller and first-time managers. I mean, certainly there's not been a dip in confidence that I've seen in terms of LPs looking at private equity as still, an attractive asset class. But I think the travel restrictions have definitely, impacted managers' ability to have those face-to-face meetings, which are, so important for the smaller and first-time managers. But I don't think the funds necessarily need to raise new funds in order to get that, to get that liquidity. So we're seeing, some funds, for instance, reopen their funds to new commitments. We've seen that on at least one occasion so far. Funds are looking inwardly to their existing investors or to co-investors to provide that liquidity. We're seeing GPs look to amend their partnership agreements to allow them to to go back to their investors perhaps on a wider basis than we've seen previously. We've seen investment strategies change so that GPs can take advantage of the dislocation in the market. And externally, we're seeing GPs look to particularly fund finance providers to to prop up their portfolio companies and also to give them that liquidity to exploit new opportunities. So I think what we're seeing, and I think you're seeing this as well, Mike, is much more innovation in terms of the types of fund finance products in the market to address the liquidity needs that GPs have in this current market.
Yep. So in the US, on the subscription facility side, the transaction volume has stayed really robust. How is the subscription facility volume in Europe?
So as you know, Mike, we cover all sizes of managers and we cover all strategies. And so I think by and large, they've held up pretty well. We're still writing a lot of new business, but I think we've definitely seen a shift in the market, as I think you have as well, Mike. We're seeing a larger portion of our Sublime book, which is being delayed. We're seeing some banks pause on new business, either entirely where they've got to focus their efforts on supporting their local businesses, or banks are focusing on key relationships at the moment and providing lines to sort of their key clients. I think as spreads have widened, partly as a result of that, partly as a result of the cost of funding increases, I think what that's done is created opportunities for other banks and institutions in the market to step in and provide that capital. And we're seeing some of those smaller banks extremely active at the moment in sort of gaining market share and perhaps developing relationship with GPs that previously they haven't been able to take advantage of. We're certainly spending a lot of our time talking to GPs and advisors and agents in the market just to figure out who's got appetite, where is the capacity in this market to both write new transactions and to take on existing positions.
Mm-hmm. And what about on the NAV side? How robust is the volume there right now in terms of actual transactions?
So I think the way we've seen certainly the European market develop is when COVID hit, there was a huge scramble to lock down facilities that were in the pipeline pre-COVID to lock in extensions and increases and conversions and upsizes. And then I think we saw a brief period of pause as GPs were considering what they wanted to do. In the last few weeks, what we've seen is that really manifest itself in terms of GPs taking decisive action as to which route they want to follow. Do they want to look inwardly for that capital, or do they want to look externally? And what that's resulted in is, I think, a real increase in volume of NAV transactions that we're seeing at the moment. I think historically, Mike, you know that we've done many NAV deals over the years, but I think with primary P, it's probably been one of those asset classes where we haven't really seen much in the way of NAV deals done. I think that's really changing. So I think previously there was a clear distinction between an LTV, traditional bank NAV transaction versus a preferred equity type solution. And what we're seeing now is really a bringing together of various features of each of those types of products to make it more attractive to the primary GP managers who have historically been a bit nervous about the NAV deals because of the ability ultimately for the bank to take the portfolio if the LTV is breached. So what we're seeing is a real convergence now of those two types of products coming together. So at the moment, we've probably got 7 or 8 of those types of lines on our books. And forecasting into H2, I think that once the valuations settle down, we are likely to see a real influx of those types of transactions across the market. And I think it feels like a really exciting time at the moment, Mike, because as these products are emerging, it really does feel like it's almost a new sort of asset class within fund finance. It's a very different type of NAV product to what we've seen previously, and it does feel like we are probably going to look back in 5 years' time and look back at this as the time that the sort of hybrid NAV product really emerged and hit the big time.
I really share your instinct that the NAV lending market is going to grow materially here over the next 5 years. I was talking a little bit with Ken Pierce about that earlier, and I do think the timing of that is right. It's spot on, and certainly looking for investments here to make in that area too. What about the transaction structures themselves? Have attachment points moved down or moved up, or how have deal terms changed because of the COVID disruption?
I think, well, a number of ways. That the product has become more flexible, and there's been an according price adjustment as a result of that, to allow it to be more attractive to GPs rather than a straight LTV breach, which results in a lender being able to enforce across the entire portfolio. What we're now seeing is sort of LTV ratchets. So, for instance, you may have an initial target LTV of say 20%, that can then increase to 25-30%, and the consequence of that is an increase in the cash sweep, and then you have a further LTV ratchet, a breach of which results in the GP having to use reasonable endeavours to sell the portfolio, and then we have the final LTV breach, which usually results in the GP having to accept that the lender can realise the underlying portfolio to deliver value. One of the really interesting developments I think in this space is, again, pricing has increased to reflect the adjusted risk of this new type of NAV product, is the number of institutional investors that are interested in this, because the returns that are now being generated on these types of products is exactly where the investors are really interested in coming into these types of products. And I do think that they'll be an increasingly important part of the NAV market.
Sam, any other market developments post-COVID that would be worthwhile to share?
I think on the product side, certainly we're seeing more innovation, more sophistication, more creativity in terms of GP's approach to fund finance products. And I think demand is certainly outstripping supply when we look at those sort of more niche fund finance products, the NAV, the hybrid, the pref products. I think from a documentation point of view, one of the things that I've been asked a few times by my clients is, in the aftermath of COVID, are we seeing any holes, any deficiencies in the structures in our deals? And the answer from my side to that is a very firm no. I think we as advisors, the bankers in the market that support the private equity industry, and the private equity industry itself learned a lot of lessons from the financial crisis, and particularly the fund finance industry, I think, also learned some really important lessons in the aftermath of the collapse of a barrage. And so I think our documentation is pretty tight, and I think that's supported by the fact that there have been very few defaults, as has been noted a number of times by lots of different people, both across the subline and the NAV line products. We have seen currently no requests for waivers on any of our NAV lines as yet.
Great, great. Well, Sam, thanks a bunch for joining us. Appreciate you making a little bit of time. Keep up the great work.
Thanks, Mike.
Thanks a lot for joining this week's edition of Fund Finance Friday Industry Conversations. We hope it was productive for you. We'd welcome your feedback on how we can make it more productive for your business. Please email us at info@fundfinancefriday or email me personally. Thanks for joining us.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.